Hello and welcome to Multnomah Group's Capital Market Review recording for the second quarter of 2021. My name is David Williams and I'm a senior consultant at the firm, as well as I chair our internal investment committee. I'm going to start with a few comments on the U.S. economy, and then we'll get into a review of the capital market performance for the second quarter. During the first quarter, the final U.S. GDP number came in at 6.4% on an annualized basis. This has been fueled by consumer spending and the continuing reopening of consumer activity. Early estimates for second quarter have the U.S. economy continuing to grow at a faster rate, roughly around 7%. Our first cut at those numbers will come out at the end of this month. But much of what we saw in first quarter continued here into the second quarter, with more and more consumer activity and more optimism being displayed in the actions of consumers and other participants. During the second quarter, we saw a little movement with regard to fiscal policy, as the infrastructure plan that the Biden administration has put forward is to continue to go through bipartisan negotiations. It appears that a scaled down version of that infrastructure plan is continuing to move forward, but making predictions about Washington movements is not something that we'll contemplate here. Turning to the Fed, during the quarter, they started to turn a little hawkish, moving from their longer-term dovish approach to a more hawkish approach, which simply means being more concerned about inflation. No immediate changes were announced at the June Open Market Committee meeting, although signaling is definitely out there that discussions of winding down bond purchasing programs that were put in place early in the pandemic are being considered. This has certainly been supporting the interest rate curve on the longer end, the 10 and 30-year term treasuries, as well as they're signaling that the rate increases for short-term rates, the Fed funds rate, is likely to maybe move forward a little bit compared to earlier expectations, although no immediate changes were announced at their most recent meeting. You may ask the question, why the changes from the Fed? And I think what is generally accepted is that inflation is certainly increasing. There's more concerns about inflation. We're seeing that in some of the current numbers of, the core CPI, which is takes out food and energy, which tends to be a bit more volatile. We've seen, 4.5% year over year increases in core CPI through the end of June 30th. You have to remember that the Fed tends to has a dual mandate of full employment as well as managing inflation. And long-term inflation targets for the Fed are roughly 2%, and they've restated that goal. And the understanding is that since we've been running below 2% inflation for some time now, that you're likely to see the Fed be comfortable with inflation on the intermediate term, a little bit above that long-term 2% target. Lots of discussion about inflation, whether or not it's transitory, as we are reopening the economy and some of the supply chain disruptions, as well as increased consumer activity that's pent up as a result of some of the slowdown during the pandemic. If this is truly transitory, or if there are structural changes that we're going to see inflation here longer term. Again, this is an open debate at the Fed, and ultimately we expect that will drive future Fed policy. The second side of the Fed mandate is full employment, and unemployment picture got a little bit better during the second quarter as we ended the quarter at 5.9% unemployment. That's a modest drop of about 0.1% from the end of the first quarter. So certainly, job postings are out there. Unemployment definitely remains above pre-pandemic levels. We had about 850,000 non-farm payrolls, non-farm positions added to the payroll in June. But there's still about 7 million or so estimated people that are unemployed due to the pandemic. We have seen another positive sign. Wages are increasing really at a fast rate relative to the past 20 years during the first and second quarter. Transitioning now to the capital markets, and we'll start in the US. The S&P 500 posted another nice solid return for the quarter, up 8.6%. For the quarter, that has its year-to-date return through the end of June of 15.3%. For the quarter, we saw large cap growth being the best style or segment of the U.S. Stock market, up 12.1%, which is really reversing a trend since about mid-August to September of last year, where value had been outperforming growth. In the large cap space, definitely growth outperforming value. As you move down cap, that difference diminishes, and in small cap, you actually see a modest reversal of value marginally ahead of growth. From a sector standpoint, real estate, technology, and energy sectors led the way, posting the best returns for the quarter. Certainly, with inflation starting to raise, with inflation starting to increase, real estate and energy, commodities definitely benefiting as a result of that. For the quarter, all sectors were positive with the exception of the utility sector. And finally, as we look at price to earnings ratio, it's not listed on this page, but we make mention of it earlier. The price to earnings ratio on a forward basis is 21.5 for the S&P 500. That is above the long-term average of 16.7. So stocks are still showing that expensive trend relative to historic averages on a valuation basis. As we flip over to the fixed income market, the Barclays Bloomberg Aggregate Bond Index was up 1.8%, rebounding from a loss of about 3% during the first quarter. Most of this is attributable to a decrease in rates. So we had a shift down in the yield curve. The 10-year Treasury decreased by about 30 basis points or 0.3%, and the 10-year note decreased by a similar amount during the quarter, a little more, 35 basis points. Interest rates have continued to come down here in the third quarter at the time of this recording. Corporate investment grade bonds outperformed like duration Treasury mortgage-backed securities. They were up 3.6% for the quarter. So the spread between Treasury and corporate investment grade bonds narrowed as investors continue to expect an improving economy, and therefore we're willing to pay a premium for that credit risk. Moving on to international equity markets. International markets is measured by the MSCI All Country World ex-US, which is a proxy for equities outside of the US, includes developed and emerging markets. Was positive for the quarter, up about 5.6%. We definitely saw developed markets slightly outperforming the emerging markets, and European stock markets slightly outperforming Asian stock markets during the quarter. Currency effects have been slightly negative for US-based investors on a year-to-date basis. And again, the longer-term trend of international equities lagging US equities continues here in the quarter. I'm going to end on this page of the unpredictability of asset class returns. With the surge in inflation results on a year-over-year basis. And I think it's important, again, to note, as we mentioned in the last The last update, that year-over-year comparisons between now and last year are certainly sensitive to the slowdown in the economy and slowdown in consumer activity experienced during the first quarter and second quarter of last year as a result of the pandemic. So it is, I think, important to take a longer term view on inflation. But as markets react to the news of this current cycle, we definitely see a rotation, a little bit of a rotation here as real estate and commodities have moved up on that far right-hand side to being the top two performing asset classes. U.S. small cap stocks moving down 2 spots. The rest of these in order were unchanged during the quarter. So inflation sensitive assets certainly having a good year to date thus far. Crude oil was up roughly 24-25% during the quarter, but we did see a poke or a piercing of the lumber futures bubble as those futures fell about 40% during the month of June. Guess I would end with just thanking you for joining our call today. And if you have any questions, please don't hesitate to reach out to either myself or your Multnomah Group consultant. Thanks for listening and have a great day.